Hello and welcome to a brand new session on DH Sparks. I am Furkan Moharkan from Deccan Herald. This time we would be talking about the personal taxes as it's the time to file the returns once again. In the post-demonetization era, as the government has been caught up between the conundrum of populism and prudence, so we have seen more tweaks in the personal taxation regimes than ever. To take us through all this and more, we have with us Mrin Agarwal, who's moderating this session. Mrin is the founder director at Finsafe India and a financial coach. She has over 20 years of experience in the wealth management industry. Welcome, Mrin.
Thanks a lot, Furkan, and hello, everybody. Nice to be here today at DH Sparks. And the hardest thing in the world to understand is income tax, and that was said by none other than Albert Einstein. You know, from being mentioned in Manusmriti, the ancient book of laws penned by sage Manu, and the Arthashastra by Kautilya, and to the Mughals, and finally to being introduced by the British in 1860, taxes in India have come a very long way. Along with it has come a lot of complexities. Welcome to this panel discussion on personal taxes, and we have a whole host of things that we're going to talk about today: the old and the new tax regime, capital gains, ESOP taxation, of course, income from house property, rental income, and you also have an option to ask your queries after the panel discussion. So do keep your questions ready. First off, I would like to start by introducing the esteemed panel. And we have with us Mr. Nityananda. Mr. Nityananda is a chartered accountant, and he's been running his practice for 42 years. Yes, you heard it right, 42 years. And he is presently the chairman of the Central Taxes Committee of FKCCI, and also heads various committees on taxation at state as well as at the national level. We also have with us Aarti. Aarti is a partner with over 17 years of experience in the area of expatriate tax at Deloitte Global Employer Services Practice in Bangalore. And she's got extensive experience in advising various MNCs on global mobility issues, such as taxation of short-term travelers, remuneration structuring. So, you know, she's going to be decoding the whole old and new, and how does it really impact your salaries as well? Tax equalization, social security optimization, to name a few of her expert areas. Finally, we have with us Srivatsan Chari. He's a co-founder at ClearTax, and he's involved with all aspects of running ClearTax, like ensuring that the product roadmap is in alignment with ClearTax's vision. He also manages different teams, which involves product design, engineering, and marketing. So welcome everybody to this particular session. And first off, Aarti, I'm going to be starting with you. And I would like to start by asking you that what is the impact of COVID on benefits provided through salary? Because of COVID, we've seen a lot of people moving back to hometowns maybe. And so what's going to be the impact on HRA, or let's say travel allowance, and how does this need to be managed, given that people might be looking at working from home for maybe another 6 months to a year now?
Hey, Mrin. Thank you so much for your kind words, first of all, and great to be here on this podium with all the esteemed speakers here. So it's a great honor. But you've raised the right question. Today we have a pandemic, which is worldwide, global, and it's great to see that employees have quickly shifted from working in office to working from home. While this shift has been, quite smooth, I would say, the tax structures, the compensation stays where they are. There's been no change, which has been kind of introduced by the government. So As you rightly said, that would have definitely an impact on the taxes which people are paying. The example that you picked up, house rent allowance. A lot of people, because of this work from home, have shifted base to their hometowns and are living with their parents. There is no rent payment that is there that they will be paying. So obviously, that's going to increase their taxes because exemption is not going to be available any longer. The same goes for other benefits as well, which are linked to a reimbursement kind of model. So basis the incurrence, they get an exemption. Now, having said this, there is a little bit of relief that is available to the employees this year. From April 2020, the employees can actually choose between a simplified tax regime and regular tax regime, whichever is favorable to them. The downside is that while simplified tax regime offers a lower rate of tax up to certain slab rates, it does not provide any some of the exemptions and deductions. So what happens is that the government takes away the exemptions and deductions, like say HRA, leave travel assistance, standard deduction will not be available, but you get a lower tax incidence. So in case employees are not going to be claiming these exemptions, then they can choose the simplified tax regime and make sure that they're not worse off as far as taxes are concerned. But they have to choose wisely, because they can, a salaried person can opt for every year, but when they are opting to the employer, they have only a one-time choice. They can change it when they're filing the tax return, but as far as tax withholding goes, it's just a one-time option. So they have to choose wisely. And if their employers are looking for reopening offices in November, December, and they would, again go on rentals, then they have to take the futuristic scenario also in part.
And no doubt, all this is also quite cumbersome. I mean, switching between the regimes is not exactly a very easy thing to do. That gets me to another question, and this one's for you, Srivatsan, which is really about the Employee Provident Fund, because there are certain deductions which are not available in the new regime. So what happens to deductions like the Employee Provident Fund, which will anyway continue to happen?
Thanks, Mrin. Happy to be here on DH Sparks and happy to be with everyone here. So it's a good question. The interesting thing is the EPF is fundamentally a different, governed by a different act. So, and it doesn't fall under part of the Income Tax Act itself. So the EPF will continue. And so if you step back, fundamentally, the government has always pushed the PF as something to, help generations of people save for their retirement. And now more and more, instead of having a government-driven tax investment sort of policy, I think what they want to do is put the control of investments and tax savings back into the hands of people, while obviously keeping a safety net for people who are, in the lower income segments. So the EPF will continue, and I think it's up to people now to do the investments themselves. And the downside of this is that, a lot of people, because of the new tax regimes, a lot of the people are have to now spend time, actually think about how they're taking care of their investments and stuff. And it doesn't just automatically come from the employer. So like Aarti ma'am said, I think working with your employer, talking to them about what your choice of regime is, and what kind of investments you're going to making, this becomes important.
Okay. So, of course, as I said, switching between the regimes is not really very easy thing to do. And imagine declaring something to your employer and then going and filing under a different regime when you're going for the ITR filing. So, Mr. Nityananda, I would like to ask you, is this actually practical? And, what in your mind do people need to do, keeping in mind the overall COVID situation and the old and the new tax regime?
Yeah, good evening to all. Namaskara. It's a pleasure to be part of this panel. And I thank Deccan Herald, because it's part of my life every day for last 40, 50 years. Without Deccan Herald, my day doesn't start. And I'm very happy that they are giving this tax education. So first and foremost, I feel like COVID is not a very long and permanent thing which will be with us. It's a temporary phenomenon. I mean, it may be 6 months, 9 months, okay. But it is not like every year it will continue. So the new system of taxation is basically applicable for the current financial year, that is 1920-21. So basic right now, immediately the salaried people will have to tell their employers, okay, whether I'm going for the new regime or the old regime. And based on that, because it's the obligation of the employer to deduct the withholding tax, that is the tax deduction at source, they will keep deducting accordingly the taxes. But the obligation of filing the return is with the individual employee, and he can choose whether to go for the newer one or the old regime. And one thing good for the salaried people, that is the non-business, non-profession income, who do not have income from business or profession, is that they can keep switching the way they like year after year. It is not so as far as the business, the people who are in consultancy. They will have to do, once they switch over back to the old regime, they cannot again come back to the new regime. So that way, there is a lot of flexibility. And basically, people who may be at the lower levels of income, I mean, lower level means I'm talking of like 15 lakhs plus here and there, plus whose savings are little less, pensioners, senior citizens, they will all, I mean, opt for the new scheme because that is much more attractive, I feel. Yeah.
All right. Okay. Thank you, Mr. Nityananda. And of course, other than COVID, one of the big things that we've seen this year is the upcoming of the Robinhood traders. You'll be surprised to know that 24 lakh new demat accounts have been opened in the lockdown. And I see that there's a lot of, so I run a financial education company, and we get a lot of queries from investors. And there are a lot of queries right now that we're receiving on investing in international stocks. There are also a whole lot of platforms that are actually available to buy stocks. So Srivatsan, can you just throw some light to us on how international stocks, so if you decide to use an Indian platform and you invest into international stocks, how is this going to be taxed in India?
Thank you. So I think, like you rightly said, Indian investors are flocking to like the US markets. I think that they feel that when a blue chip stock falls down, like time to buy it. And you can see a lot of seasoned investors and a lot of young people as well buying a lot of the blue chip stocks. And if you just look at it, fundamentally, you have to think about just short-term and long-term holdings. And from a tax perspective, anything that you are any capital gain event that's happening in 24 months, that's looked at from a so sorry, let me step back. All international stocks that you buy are going to be unlisted because they're not listed in India. And if you have a short-term holding, it's going to be taxed at the slab rate. And if you have a long-term holding, it's going to be 20% after indexation. So this more or less looks simple to people, but it's not that straightforward. There are a lot of different rules that apply here. You have to take into account the rate, the cess, the surcharge. Taxes apply, like you'll have to calculate all of this at a line item level. And I think because we run a tax platform, one of India's largest tax platforms, millions of people file. You see all of these different types of use cases, and we see a lot of people obviously like doing this themselves and doing it correctly. But we see a lot of people going wrong with international taxes and stocks as well. High level recommendation is talk to an expert, like work with them, understand like what the sort of use case that you have is, and get them to walk you through like the kind of taxation that you have and how to file your return appropriately. Yeah, so when it comes to, and there are different use cases also. You'll have like something related to RSUs, you'll have things related to ESOPs, or you may have to calculate the days, fair market value, etc., etc. I think like people should end up spending a lot more time thinking deeply about stocks and investments, but do talk to an expert when it comes to international taxes.
So the general rule is that since it's unlisted stock, basically long-term capital gain kicks in only after 2 years, right? And if it's below 2 years, then it's going to be short-term capital gains. But I think, so by the way, there's also a poll that's out there on your screens, and please do answer the poll. We will have another 1 or 2 polls coming up. And, this really brings me to another part of, this whole investing in international stocks. Is the whole ITR2 filing as far as capital gains is concerned. Not only is it quite, I recently read that that under Schedule 112A, each taxpayer needs to enter details of each of the trades. And so for each of the trade, you need to mention the ISIN number, the share name, the quantity, the sale price, the purchase price, the fair market value as well. And not really very easy for most people to actually do this. So certainly, I think, you're better off working with a tax consultant who can really help you with your ITR2 filing. But, with such sort of reporting requirements in the ITR, and of course, it's not very easy for most people to actually maintain a whole lot of these documents. The process of filing has become very complicated for investors. So, Mr. Nityananda, what would you say that investors need to do in order to simplify this whole 112 schedule filing for themselves?
Yeah, I mean, though initially people felt it's too complicated, it is not so. The reason is people who are regularly trading in stocks, buying, selling. So they do have their advisors or stock exchange members who have devised the respective Excel forms in which they provide all the details which we can just attach and fill up the returns easily. So if by chance those people have not given proper details, or the investor himself has not really followed up and timely taken all those details, then and suddenly he is also rushing at the last moment, then there could be a sort of question mark and problems. Otherwise, I don't see such problems, but only my advice to people who are regularly trading is kindly, at least if not on a weekly basis, if you are not doing in a large scale, at least on a monthly basis, get all these details, and also the security transaction tax. There are so many issues which are involved. And as you said, various numbers, fair value, everything. And for quoted stocks, it's much more easier. It's only for the unlisted ones, you will have to be much more careful as far as the valuations are concerned. Because if valuations are not as per the fair value, then additional taxation you attract.
Yes, and now that we're talking about valuations, Bangalore being the startup capital of India, no conversation about tax is complete without talking about ESOPs and RSUs. So pretty much, I think, as far as if you are an employee of an MNC which has given you ESOPs or RSUs of their company abroad, it is treated as unlisted shares. But then you also have ESOPs from companies in India. And Aarti, I would really like it if you could throw some light in terms of, what investors need to keep in mind as far as ESOP taxation, specifically of Indian startups is concerned.
Right. Actually, we see a lot of startups and giving ESOPs. The reason being they're kind of hard on cash, and stock awards seem to be an attractive option for remunerating people and attracting talent. So that's pretty much common. But what happens is in India, since most of the startups would be unlisted, they would need to obtain a merchant banker valuation for determining the perquisite taxation. So the way taxes on ESOP run is at the point of grant, there is no tax. But as soon as the stocks are exercised by the employee, on allotment, there is a tax, perquisite tax that's gets attracted. And the difference between the fair market value on the date of exercise, less whatever price the employee pays, is taxed as a perquisite in the hands of the employee. Now, one must remember that at this point of time, there is no cash available with the employee at all. So he's really has a liquidity issue. And fortunately, the government, recognizing the fact that there has been challenges on this ground, they have kind of deferred the taxation of perquisite for eligible startups. And this word eligible startup is very important. I will touch upon it a bit later. But they have deferred the taxation on perquisite taxation to the point of sale, or to the point when the employee actually separates from the company, or to 48 months from the end of the assessment year. So 3 triggers. Earliest of this is when the tax will trigger. Now, the challenge actually is that even if the employee separates from the company, or even in the case when the 48 months time period lapses, there is no assurance that there is liquidity with the employee, because these startups will have a funding or a cash out only when there is a venture capitalist investing into the company, or they go public. So which is where the challenge probably deferred and eased out a bit, but still continues for startups. Now, the challenge also is enhanced by the use of the word eligible startups, because eligible startups will have a certificate from the DPIIT, and it's not an easy certificate to get. So there are lots of conditions. So to get that eligibility certificate itself, very few companies would qualify, and which is where very few employees are benefited by that. So that's the challenge that people will face over here. Yeah. To your second question, Mrin, in what do people really have to do? 2 things. One is basically ensure that they are getting a certificate from the employer in terms of what is the fair market value considered for perquisite taxation, because that is the value that is going to be considered as the cost of acquisition at the time of sale. So that is very, very important. The second thing is to ensure that if by, because it's a 48-month kind of a delay in difference of tax, in case the employer is not deducted the tax, then the employees have to take up the onus and make sure they're paying the tax. So
wow,
2 things.
that doesn't seem very easy to do, honestly.
No, it's not. No, it's
not. People don't keep track of dividends. I think it's going to be quite difficult for them to keep track of fair market value. So anybody, what could be a way to basically automate this for people?
Mrin, so I think, like the panelists have said, this is really a tough one for people, and especially people working in MNC companies who get like RSUs and people who invest abroad. I think everyone gets like a Excel report, or you have your CAMS report as well. So one of the things that we do well on ClearTax, like the website, is you can just upload the CAMS report or the Excel report, and we automatically pick up all of the values and compute all of this. We take into account like, the fair market value, we take into account the dates, STT, et cetera, like really simplify it for people who want to file taxes themselves.
Sounds good. Now, we actually ran a poll during, and you might have seen it on your screens, on which part of Indian tax pertaining to personal taxes that you find the most difficult to understand. And can I just request for the results up on the screen? We actually gave 3 options: tax computation, so that's really your ITR filing bit; capital gains; income from house property. I'm a little surprised to see that. So because we're going to have a good conversation right now on income from house property. But clearly, I think, tax filing is really not easy, despite the form being known as Saral. I think it's not an easy thing for people to do. Moving on, actually, Srivatsa, another question that I have to you is really to do with taxation of cryptocurrency and peer-to-peer lending, because these are newer investments where we do find a lot of millennials wanting to invest. So, without really commenting on whether these are good or bad investments, but how do these get taxed? Do they just get taxed at the slab rate?
Got it. So very interesting question, and like a loaded question as well. So with respect to cryptocurrency, there are no tax laws right now which govern them. There's no direction from the government or anything with respect
to. It's not regulated by any regulator. Yeah.
So do you look at it as capital gains? Do you look at it as like income from other sources? Like it's not clear. But that doesn't mean like people can just keep that income aside or not disclose that, like, because the Income Tax Act fundamentally says, look, any income is taxable. So any cryptocurrency gains that you have is taxable. Like when we sort of get these questions, we typically refer people to a tax expert. And high level, what I understand, like the kind of direction in which people talk to is like when it comes to a small amount, people consider like you could possibly put it into income from other sources, and that takes that is taken care of at the slab rate. But if it is a large amount, then you want to, like, people actually talk about, should I treat it as a capital asset? Should I look at the period of holding? Look at the indexation and certain other aspects. So depending on the sort of quantum here, talk to your tax expert, like understand, walk them through what happened. And I think a treatment from that perspective will really help. So that was your first question. And to the second question around P2P lending itself, I think like the like P2P lending has actually happened for a long time, right? Like people take business loans from family, friends, etc., etc. So from the perspective of the lender, the interest that you earn with respect to like P2P lending, that goes into income from other sources and taxed at a slab rate. But from the perspective of the borrower, I think what's important is the loan needs to be like taken care of and like addressed in the liability of the ITR, and the interest expense, that's something that you could knock off in the profit and loss statement.
All right. So moving on, I actually want to spend some more time now on some other aspects of taxation. And before I move on to the whole house property related taxation, I would like to actually talk about clubbing of income tax, because, this is again a very common question that we get, especially in cases where, let's say, one of the spouses is not working. I have just listed down a couple of questions that we get regularly, and I'm going to do this like a small rapid fire with just one person. So first off, Aarti, you're first off.
Okay.
So this is really to do with clubbing of income and tax payable. So, very commonly seen that people tend to transfer money to one of the spouses who may not be working, and then take all the other benefits. Now, how does this get treated? The moment you transfer any of your income to your spouse and invest in the spouse's name, what happens to the income that the spouse earns, and does it get clubbed with your income or not?
Yeah, thank you. Clubbing is something which the tax authorities have kind of addressed a long time ago, but somehow a lot of people still continue thinking that this is a great idea. Clubbing is kind of nipped in the bud because there are strict provisions which talk about, if income or an asset is transferred to your spouse or your minor kid for inadequate consideration, then in that case, that income will be still clubbed into your hands. So where you are, considering transferring a fixed deposit or maybe a rental income in the name of your spouse, that doesn't really help, because by law, it will again be tracked down and it's required to be included in the hands of the taxpayer himself. So the idea is to take the benefit of maybe slab rates and the threshold, which is not subject to tax, but that doesn't help too much. It will still be included in the hands of the taxpayer.
Okay, all right. Coming to you, Mr. Nityananda, I would like to now talk about income from house property. And specifically, the first question that I have is that would rental income, can it be charged to tax in the hands of a person who is not the registered owner of a property? So let's say the property is owned by a person A, and the rent is being taken, let's say, by the wife, which is person B. So how does it work out in these cases? Because she's not the registered owner of the property. So can she take the rental income first of all?
No, it all depends on the type of agreements which exist. I mean, it may be wife or it may be any other person. So it depends on the type of agreements which exists between either the landowner and he may lease out and take a ground rent and give it to some other person, whether within the family or outside, on a fair sort of rent. And then that person constructs the building and gets the rent. It will be still house property in the person who constructs the building. But if you, as you just asked the question or just made a proposition, like someone transfers some income or some source of income, but there is no adequate consideration from the other person who is a family member otherwise, then I mean, there are sections. Earlier, there was little sort of room for planning, but with section 56 coming in and various other sections corresponding coming in. So without proper valuation, proper consideration, definitely everything will finally get clubbed in the hands of the person who has just transferred. And I would like to take this opportunity to inform our listeners, whoever is attending this webinar. I would like to inform them kindly, I mean, don't go by the advice of, say, friends. What happens is I go and sit in the evening in a club, 10 people will talk what they did and how they are saving tax, or someone gives some advice like that which is not professional. Because whatever, I mean, law gives you lots of opportunities to save tax. Please use them fully, but don't try to sort of go by hearsay or which is not a professional advice. That is what, because now most important is the department is fully geared up. They get information from all sources, whether you do your bank transactions, whether you do your stocks and shares, or you buy some big gold jewelry, house property, car, or foreign travel, everything gets tracked. It is not like, and also whether you do it on a WhatsApp call, WhatsApp message, everything is under the radar of the department. So that way they are quite well equipped, but not that they are policing, but it is required. I mean, as citizens, we pay tax for the development of the country. So we should be sort of careful. That is what I would request all of them.
So coming to friends and relatives, right, with whom you have that evening tete-a-tete, can interest paid on loans taken from friends and relatives be claimed as a deduction while calculating house property income?
The question is for me?
Yes, Mr. Nityananda.
Yeah, okay. Yeah, I mean, you can claim, but again, you see, there are lots of provisions under the income tax law called section 269, SST, various things. So you can't take a loan beyond a amount in cash. You will have to take by account pay check, bank transfers, and you can't take it otherwise. So that way you will have to have bank transfers, proper documentation, then alone, I mean, you can claim. And then there are restrictions as far as the self-occupied property. There is a restriction on the amount what you can claim as interest payment. But if it is let out, yes, you can keep claiming whatever you have incurred otherwise.
And coming to the point of self-occupied property, again, this is a very common question that we get that, for example, I have two houses. One could be a farmhouse that I visit on the weekend, and one is in the city that I use on the weekdays. Or, you could just have two apartments in the same city. Maybe one of them is not let out. So how do you, which one do you treat as self-occupied? How do you decide that?
No, that is the choice is given to the assessee, which one to choose, number one. And also number of people, they do not offer any rent if by chance the property is not occupied. It is not so. I mean, by your own volition, you just lock up your apartment, whether it's in Delhi or Bangalore or elsewhere, and you don't pay taxes. It's not correct. There is a concept of annual value. Whatever is the fair rent you ought to have got, so that you will have to offer to tax. In fact, that is another big challenge which has come to all these developers, because of course they have been given a particular time frame. But beyond that, if they have the vacant inventory, they will have to offer the rents on such properties. That type of challenge has come. So maybe the government or the department has not gone deep into these details. But as I said, now every detail is getting into the system. So if you have houses which you're not let out and living the one which you want to sort of say it is self-occupied, so you will have to offer whatever is the fair rent and give the notional rent and pay the taxes on such notional rent. Otherwise, you will get into trouble.
So, Aarti, again, since we've just been talking about the fact that everything can be easily tracked today because of all the digitization that we've seen. And now recently also the government came out with some plans. I know that these have not been made laws yet, but with some plans to basically track expenditure on different things. I mean, of course, they've already notified electricity and foreign travel and stuff like that. How do you actually see this impacting the self-employed or the business class? Because all this while we've been talking about salaried class, but I think a lot of these would certainly have an impact on the self-employed. And so how do you see this? How do you really see the tax compliance going up?
Definitely. There are checks at each and every point here, Mrin. The government has done a lot to make sure that tracking is in place. And as Mr. Nityananda called out, it's really not worth it to try and take the path that probably was inappropriately taken by you in the past. It is necessary to get professional help here. What happens today is the government systems are all talking to each other. So even if we are talking about, say, an immigration system or a provident fund system, the tax system, your property registration, it's all linked. And there are, the PAN and the Aadhaar has become the keywords. Without that, you cannot even take a single step. So your checkpoint is there at every single step out here. So these are informations which the government gets from, secondary sources. There is also another source that a lot of financial institutions, banks do on a regular basis share information to the government in an additional information report. So they have visibility to all your financial transactions beyond a certain threshold. The third kind of access is your own return. The returns, while as you called it out, it's Sahaj and Saral and all that, but there is nothing Sahaj and Saral about it any longer. So you have your foreign assets reporting there. So as Srivatsa called out, if you're holding foreign shares, you better report it there. It's necessary to do so by a resident. You have to report your Indian assets. So there's a lot of information that you yourself are going to be giving in your own tax return. And the last but not the least is going to be your transactions, your daily transactions. I mean, you have not only the online portals or your shopping spree that takes up digital money, but you have your local vendors who are asking for Paytm and Google payments kind of situation. So your local vegetable vendor also does that digital payment. So when you are doing something which is paperless, which is on a card, there is a record which is created. So the visibility is very, very high. And it's not just restricted to India. The government has actually signed agreements with a lot of overseas countries to get information on people from Indian origin and Indian citizens on what kind of transactions they are having in those countries. Because a couple of years ago, the government had launched the Black Money Act, right? So that was the whole idea, to get access to funds which may have escaped taxation in India and are parked overseas. So I don't think it's a great idea to continue if people were doing something which is not right earlier.
And this brings me to the last question, which I would like to ask Mr. Nityananda before we open it out to the viewers, which is, for senior citizens, right? It's not exactly very easy to keep track of tax documents. And sometimes you also don't get the documents on time, right? So, and you just end up doing a lot of running around. Of course, everything is not even electronic right now. And even if it is, there are still a lot of delays. So I would just like to, the last question that I would like to address would be certainly for senior citizens in terms of, what you think, how can they basically ensure documentation correctly?
I mean, the service to senior citizens is very close to my heart. It's nice that you asked me this question. See, basically, by and large, if you see the senior citizens, they keep track of their affairs much better than the youngsters, if I can say. They're too good in their corporate employments or the professions. But when it comes to their tax compliance, we find that senior citizens are way ahead compared to them. So whether it's senior citizens or others, my suggestion is the days of just going on the last week before the deadline for filing the returns and somehow rushing through your tax compliances, those days are gone. And we should forget those days. We should now know that every day there is a tax compliance. If by chance I'm getting an income today, if I'm getting an investment I'm selling and a capital gain arises, I had to keep track on a day-to-day basis, because it is much easier for getting a transaction detail or a certificate, whether it's a financial institution or a bank or anyone else, or even a property transaction, just to get a copy of the sale deed of a property sold is much easier than 12 months or 18 months later. So that way, my request to senior citizens, to all other tax citizens, is that please don't postpone your tax records collection, tax evidence collection. It's a day-to-day business like breathe in and breathe out. The pranayam, what we do, please, keep a track of your tax compliances day in and day out. Then tax filing time, you will breathe very easy. That's what I would like to say.
All right. So with that, can we just have the second poll, please? And, we would just like to understand from the audience that what part of taxation would they like simplified? So, whether it is tax filing or it is capital gains on equities, or, they want better deductions, because certainly if we look at ATC deductions, we've not seen a big change for the last many, many years. And the amount of deductions have really not kept pace with our incomes. So yes, would request the viewers to vote. And I think we are good to start with the viewer queries now as well. Can we start? Yeah, I can see it, yeah. All right. So so while you vote, I'm just going to start the viewer query. So there's a query here which says that I would like to ask the esteemed panel about their opinion regarding taxation for senior citizens. Are senior citizens better off with the new tax regime or remaining with the old tax regime? So maybe Mr. Nityananda, just continuing on the whole senior citizen law conversation.
Yeah. It all depends on your level of income, number one, and more importantly, the savings and the deductions what you are enjoying. By and large, if he is a senior citizen, he is not having ideally like a business income or a professional income. It is basically income from investments or such a house property, such things. I feel the new regime is very simple and easier for him to handle. But every year you can make a choice. So it is not a very difficult thing to compute your income under both the systems. So whichever is advantageous, I advise that senior citizen to opt for that advantageous system, the older one or the new one. That is what I would suggest. But the newer one is much, much simpler. And the slabs are up to 15 lakhs. Beyond that, only you pay the highest level of taxation. Because many people also, I mean, incidentally, I should say, people feel that the taxes are very high in India. It is a wrong thing. I mean, living countries like some United Arab Emirates, Oman, or Qatar, like that, by and large, if you take all the advanced countries, the taxation is much higher. It is like 55, 57, that level of rate of tax. So we have traveled from 95% of rate of tax to almost 30%, which is the highest slab. So that way, let us not be under the wrong or mistaken impression that elsewhere it is much lower and it is very high here. Even if you take China, it's like 40, 45%. So it is the even UK, elsewhere. So that way, 30% is a reasonable level of taxation. So let us declare all our incomes, pay the tax, and have a good night's sleep. That is what I would like to suggest.
All right.
So adding to what Mr. Nityananda said, so we actually did data-oriented study for all of the employees at ClearTax, and one of the things that we realized was the new regime is actually good from the perspective of it has lower rates, but it really depends on behavior. If at the end of the day you are someone who meticulously takes care of your investments and does all of the old regime is probably better for you. But if you're the type, like, and a lot of young people are, they wake up at the last moment and like, oh my God, what do I do? It's almost March 31st. Where do I invest? Then probably the new regime is the right thing for you.
All right. There's a question here on capital gains, and any one of you can take this. If I gift a site to my spouse and if he sells it and we build a house on another site which is owned by him, can he claim the long-term capital gains exemption on the site sold in his returns? I would think so, but looking for a confirmation. Mr. Nityanand?
Okay. I mean, if I understood the question right, the asset that the site is being gifted, right?
Yeah, so the original site
is original site is gifted. So the site, if by chance it is not earning any ground rent or otherwise, so there is nothing like income which is escaping tax in the hands of the donor. The asset is only being gifted. And as you know, the gift between the relatives, there is a definition of for relatives.
Yes.
So under the tax law, so if by chance the spouse is naturally definitely there, so there will be no tax as such at that moment. But whenever the property is sold, what we should know is whatever is the net tax which arises out of such transaction will again get clubbed in the hands of the donor. What I would like to mention is, like, when the capital gain arises, if by chance you invest in bonds, because only earlier we could invest in bonds, whether it is you sell shares, you sell land, you sell building, you could have invested in bonds, which is called 54 EC bonds, infrastructure bonds, like the highways authorities, rural electrification corporation. Now it is restricted only to transactions of land and building. So in this particular transaction, it is land, so they can invest in bonds, or they can invest in buying a house within 2 years or constructing one within 3 years. They can also do 1 year earlier also, that is also available. So if that option is exercised and still some more balance is left in the capital gain tax, in my view, it will get clubbed in the hands of the spouse who is gifting. But by chance, the entire thing is covered, nothing to be clubbed in the hands of the spouse who is donating the or gifting the site. That is my opinion.
Thank you so much for that. We have Shruti Ravinarayan, who is going to be joining us over audio. So Shruti, can you go ahead and ask your question, please?
Hi. So my question is regarding the 80D given by the MNCs, and Like, what is the use and how they, like, what is the benefit of that?
So you want to know about the health insurance cover provided by the employer. What is the benefit and how can you claim it under Section 80D while filing returns?
Yes, exactly. Yes.
All right. So any of you could answer that, please?
I mean, if others are taking the question, they can go ahead. Otherwise, I will just.
Anybody?
Sure. So, sorry.
Go ahead, Srivat.
So the 80D basically allows you to claim, a maximum of 25,000 in terms of deduction for yourself and your family, and 50K for parents. So that's something which everyone's just sort of encouraging you to take a cover for family.
Oh. Basically, you see, one thing what we should be clear is, except for the preventive health checkups, everything else, the premiums we will have to pay by not by cash, but by check or account pay. There's transfers. That is number one. We should the assessees should take care. Number one. So majority of the assessees also do not take the benefit of the preventive health checkups. They think only the premium which they pay to the insurance company they can claim, and not the preventive health checkups. And now people are very conscious of their health and they're going for the annual checkups. So up to 5,000, you can claim deductions for your preventive health check also. And also, if there is any major medical expenditure also, you could, claim under the relevant sections of income tax law. So these, I feel, the assessees should be fully aware of.
All right. Okay. So
but the question was employer. I couldn't understand that question. They were saying the employer.
Yeah,
because,
so the employer provided health insurance cover is what they were asking about. That how do they claim it under the Section 80D basically?
No, you see, for you to claim anything, please correct if I'm going wrong on the facts. As I understand, if the assessee is not paying an insurance premium, how can he or she claim a deduction under 80D is my question. So whatever Srivatsan, Chari or me explained is for premiums paid or preventive health check, whatever you pay as an assessee, which you can claim. But if it is the employer is paying something for you, it is basically, it will be governed by the perquisite taxation or salary in lieu of this one. That will get covered. It will not be like a 80D. So I'm a little confused on that question, that part of the question.
Yeah. So what happens is at times there are two kinds of things that possibly happen, sir. One of the things is that where the employer pays the benefit, and in which case you are absolutely right, it is a part of perquisite taxation, and there is an exemption available for IRDA approved insurance coverages. But there are also several schemes through which the employee can, through the employer, contribute towards the insurance coverage. For example, a lot of employers cover for the employees of the company, but for an add-on for their parents or in-laws, in those cases, the employee actually pays from his own pocket. So in those cases, yes, to the limits that you have specified, that will be available. I suppose that addresses Shruti's question.
All right. So there's another question from Deepak, which says that if an asset of a deceased person is sold, how will the capital gains get computed? Does it need to be paid equally by spouse and children, distributed equally? Or can it be paid by one family person who is given the authority to execute the sale of the property? So the question really is that I think there is an individual who has passed away without writing a will, and the spouse and the children are the legal heirs. Now, whatever is the property that has been inherited, how does it get taxed? I mean, who pays the tax on it? Is it because the property would be inherited together by all of them, right? From what I understand. So who's going to be paying the tax, and do each one of them pay equally, or how does it work?
Should I go ahead, or anyone with that?
Please go ahead, sir.
Yeah. See, basically the family law to which the deceased person belongs to, that will decide how exactly the property will flow to the legal heirs. So typically, if you take the Hindu Succession Act, so if a person dies what is legally called as intestate, that is without a will, then the family law will come into operation, and it will go to the legal heirs in the proportion in which they are entitled as per the Succession Act. So if you take a typical case like a wife, then son and daughter, all of them will get equal shares. So all of them will become like, one is there is a creation of a HUF like situation which will come in. And one is they can then and there decide that they will have their individual shares. So if at all that property gets sold, whether one person signs or whether the Khata and tax records in the corporation records are in the name of the deceased person's wife, still, I mean, all the three are equally liable for taxation on whatever is the sale proceeds and the capital gains thereof.
All right. Okay. So with that, can we just have the results of the poll, please? All right. So the question was, what part of personal taxes would you like to see simplified or changed? And the options were the tax filing process, no capital gains on equities, and larger deductions. So clearly, people do want the tax filing process to be simplified further, and we could all probably do without capital gains on equities. With that, we can, I would like to just wrap up the session. And thank you so much to our panelists. I think, throughout all the questions that we covered on various aspects, whether it was income from house property, or it was salaried income, or it was business income, I think the one common thing that really came out everywhere was that tax compliance is certainly going to be the mantra going forward. And as individuals, whether it is for your business or it is for you personally, I think you're going to be better off if you keep a watch on your documents, be in control of your documents, and don't look at doing it at the last moment, right? Spend some time regularly to update documents, and no longer are all those, how do I put this? No longer are all those machinations that we did in the past going to work in the future, because tax compliance is what is the future of taxes now in India. With that, it's a wrap up of Deloitte Sparks, and thank you for all viewers for being with us today. And thank you, Mr. Nityananda, for your time. Thank you, Aarti, and thank you, Srivatsan. It was really nice having each one of you giving diverse opinions on your areas of expertise within the tax structures. Thank you.